In this video, I'm going to share with you how I raised $1 million for my business online with Wefunder and how to raise a seed or pre-seed round for your startup. If you're not familiar, Wefunder is the top equity crowdfunding platform for startups to raise funding on. It's a relatively new way for startups and small businesses to raise money online from both accredited and non-accredited investors. Because of some of the regulation changes in the last few years, now anyone can invest in startups for as little as $100. I've done this 3 times for my business, raising $1 million. So if you want to learn how I did it, make sure you watch this video until the very end. I'm going to share all the steps that I took and the tips if you're considering raising a seed round or pre-seed round online. And then I'm going to show you the good, bad, and ugly of raising money online through this method. Now, just a few months ago, I was speaking in Cairo at Rise Up Summit. And if you're not familiar, Rise Up is the largest entrepreneurship summit in the Middle East. And I spoke on how startups can raise money online from their customers through community rounds. A community round is when a startup lets thousands of their customers, users, and fans invest alongside VCs and angel investors, or instead of VCs and professional investors entirely. If you're new to the channel, welcome. My name is Ferris, and I'm the CEO of a company called MySwimPro. For the last decade, I've been building this tech and media startup, and today it's become the top swimming app in the world with over 1 million downloads. I also just published a book on how to invest in startups and founded the Startup Investor Academy, where I teach people how to invest in startups and find the next billion-dollar idea. So if you like my perspective, make sure you check those out down below. Before we get started, a quick disclaimer: I am not your financial advisor. This video is for entertainment purposes. Do your own research. Remember that investing has risks and raising capital has risks as well. So let's go ahead and get right into the video. Why would you raise online in the first place? So you've got a business, and if you're an investor, you're maybe thinking, why would a company let me invest in this business? I surely want to do it. I've seen it on Shark Tank, but why would I get involved? And if you're the entrepreneur, why would you take this potential risk? Let's talk about that. So I have 5 reasons. There's plenty of reasons. Obviously, if I did it and other startups, thousands of startups have done it, there's probably something there. So number 1 reason is you get to market the business that you have and your products and your services, and you can raise money at the same time. So you're already putting in this investment in time, and you're already committing a certain amount of marketing. You're probably creating videos, you have educational material. May as well allow your customer base to actually invest and leverage that marketing asset and raise money at the same time. So if you're looking to raise money, if you're trying to market your business, do them both at the same time, kill 2 birds with 1 stone, and that's the first reason. Second reason is it gives your customers skin in the game. Basically, you can have a group of ambassadors, of evangelists. So we have almost 600 investors in our company in over 50 different countries all over the world. So if you have an audience, if you already have a customer base, if you have the reach, if you have an email list, if you have a way to get in front of people, it allows them to get skin in the game, and you can reach them relatively easily if you have some type of a connection or an audience or a way in to communicate with them. Reason number 3 is you can raise money fast. One of our rounds, we raised almost $500,000 in only 3 weeks, and we just sent a few emails. I talked about that at Rise Up Summit in Cairo. Basically, in a few minutes of setup, sending a few emails, we had $500,000 from over 200 people. So pretty powerful and pretty fast. So you have the opportunity to raise money even faster if you're a bigger business, you have a bigger audience, the market's more developed, stuff like that. Reason number 4, it is low risk in the sense that you can actually set this up, link down below, and you can get started in 15 minutes, and you could potentially raise up to $5 million and not do any work from a legal or tax perspective, because you can actually let people, you can test the water. So you can set up a landing page, visit the link down below, and you can have people basically pledge to invest, and they can make investment reservations. And through this process, you can actually assess on what the validity is of your campaign to actually raise money. If it turns out things are going well, you have a few hundred people or a few $100,000, and it's all just sitting there, you can convert that campaign from a pledge to reservations to actual commitments, and you can actually then do the legal paperwork and all that stuff. It's not paperwork, it's all digital, but you know what I mean. You can actually go through the whole process and actually pull in those funds. So it's relatively low risk because you can basically poll the community and see if they want to invest, and you can do it really, really fast. And it's a proven model. So I'm talking about my personal experience, but companies that have raised on Wefunder alone have raised over $5 billion in additional follow-on capital. There's multiple equity crowdfunding platforms. They're calling it a community round, but basically there's a ton of platforms out there. Billions of dollars have been raised in capital after the fact of companies raising hundreds of millions of dollars on these platforms. So there's a clear historical reference and case studies that you can look at. Hopefully this video is a case study for you guys. So to help you better understand how this works for my business, to give you some context, I'm going to talk about our funding history and all the different ways that we've raised funding over the years. Then I'm going to talk about how this actually works and how we set up a campaign to really give you a step-by-step guide of what we actually did. And things have changed, and I'll update that. And then I'm going to talk about our traction as a business and what we did differently at each of the rounds based on our traction, based on our community, and based on our learnings. So if you're setting up a campaign, you can understand how we move through that. And then I'm going to share the good, bad, and the ugly, and why I think we could have raised more money in this last round and why we didn't. So let's go ahead and talk about our funding. So in the beginning, I launched a company in 2015. That's when we incorporated, and we were bootstrapped. The only seed capital was sweat equity with myself and my two co-founders. We didn't take on any like friends and family type of stuff. We basically just worked nights and weekends, grinding it out, and that was the business. Then in 2016, we raised $50,000 from the University of Michigan Accelerator Program. So we went through an accelerator program. They invested initial capital. There's a lot of accelerator programs out there. There's even more than in 2016 today, and they're giving more money than $50,000 investments. A lot of them are doing 100, 150. Y Combinator, I think, is 500,000. So that's all we had, and we started generating revenue. So in 2016, we had, in terms of traction, we had an app in the App Store, we had revenue, a little bit of revenue, and that's how we raised that. Then in 2017, we did our first regulation crowdfunding. So I'm going to call that's regulation CF. So I'm going to put crowdfunding. We raised $130,000 from 137 investors. Now, one of those was a venture capital fund that did half of that round. So they did $65,000, and that was all committed right there. Then in 2018, we didn't raise any money, zip, zilch, zero, nada. And then in 2019, we raised another regulation CF, and that's what this was, and we raised $465,000 from 205 investors. We didn't really raise, I won a pitch competition that had a $50,000 investment later in the year. So in total, we raised over $500,000 in 2019. 2020, the pandemic hit, and that same fund, Invest Detroit Ventures, put in $80,000, and that was a convertible note. Then in 2021, we launched the community round, the third one, and then we didn't close it until 2022, and we raised $344,000. So as you can see, over the years, a lot of different milestones, which we'll talk about, but we've also raised capital in a lot of different ways. So I talked about, we did the pitch competition. I've also won several other pitch competitions, which was prize money, in total over $100,000. We got PPP funding. There's some other grants here and there, non-dilutive capital. So if you total it all up, our investment raised is about $1.1 million. Equity crowdfunding was about $1 million, and then in total capital raised from other funding sources was about $1.4 million, just under, but some of that was just basically free money grants. So that's a little bit of our funding history. Now let's talk about how it works and how we did it. So before any of these rounds, we actually did an informal poll with, privately, right? So I have people that I know, and basically I sent out a survey and I said, hey, John, would you be interested in investing in my company? And if so, how much? Now at the time, I believe we actually probably bended some rules in terms of what the SEC allowed for, but now it's so much easier. You can actually petition a startup, and if you go to communityround.com, you can actually see companies like SpaceX, and people are petitioning private companies, and they're trying to get investment. There's also a more formal way now. It's called informal, but it's really kind of formal, where you can test the waters. I talked about that right here, and this testing the waters basically allows you to poll a community, set up a page in 15 minutes. And by the way, if you guys do go through that process, link down below, and you set up a page in like 15 minutes, you start to get investment reservations. You can do all of that without filing anything. And then if you choose to convert that into an actual campaign page and turn reservations into actual investment commitments, then you can actually raise the funds. And if you use my link down below, you actually save $2,500 on the fees that Wefunder, the platform, actually takes once you successfully raise a campaign. So they get a commission, that's how they make money, and you get a discount. So check it out, support me, and support yourself with $2,500. So that's step number 2. You get the poll, and then you have to set up the campaign page, and you have to choose your investment terms. Now, I'm gonna go through each of our rounds and talk about the investment terms, but in summary, 2017, 2019, and 2022, we raised with a SAFE, a simple agreement for future equity. We had different valuation caps, and we'll talk about that. But just so you know, we raised with a SAFE contract. If you're not familiar with a SAFE contract and other types of investment vehicles, I actually did a video specifically on what the heck a SAFE actually is, how it works, how I use it, and I gave examples. So check that video out. Maybe I'll put it somewhere here. What are SAFEs and how do they work? So you have to set up your page, create your compelling story of why you're raising funding, what you'll do with it. It has the video. You create your marketing materials, and then you set up a pre-launch campaign. So like I said, you can actually set up a testing the waters campaign. You basically put the start date in the future, and you actually send it out, and you start to get people to make reservations to invest, and no one sees how much you've raised until your actual launch date. And when you launch, ideally, you already have $50, $100, $200,000 already sitting there, and that way people see it and the general public sees this and they're like, oh, I gotta get in. Then you have to set your closing date and you create urgency and you close the campaign, they wire the money from escrow, and you just raise money online through a community round from the general public. Like I said, $100 is the minimum for most of these. I'll talk about what we set as our minimums, but it's pretty easy. So if you guys wanna just tinker with it, go ahead and check out the link down below. Set up a page in like 15 minutes. It might take you 10, it might take you an hour. You might want to spend a few hours on it, up to you. But don't put too much time into it. Basically set it up, put it in the minimum, and then send it out and start to see what traction you get. And if you choose to convert those into full commitments from reservations, you'll see where you're at, and you can make that decision later. So let's go ahead and move into the 3 campaigns we did, and I'll talk about specifically what we did well, what we did poorly, and what we did kind of in between. So 2017 was the first round, and what I did was, to make this easy, I basically created a table, and I talk about the different components of each of these raises. So what phase would you consider it in terms of, what do people call these things, pre-seed, seed, whatever? Then how much traction did we have from both a fluffy, surface level and also revenue? So how much money did we have? What were the investment terms we raised on? How long, the perks, and then how much did we end up raising from how many people? So let's talk about 2017. We call this the PreSeed Round because at the time, we had an app in the App Store. This was 2017. In 2016, we were App of the Year by Apple. So we weren't a big app. We weren't generating a lot of revenue, but we had a lot of hype, and we had the statement that we were App of the Year by Apple, which is kind of a big deal. It's funny, we told people we were App of the Year, and they're like, haha, yeah, like, who said that? Apple, like Apple, the company that makes the Apple Watch, yeah, them. So we had some fluffy traction on the top line, but then how much revenue were we doing? We were at about $100,000 annual recurring revenue run rate. So, that's annualized, right? So we weren't like making tons of money. Less than $10,000 a month. It was just a few $1,000s per month actually, leading into the campaign. We raised at a SAFE at a $5 million valuation cap, and we had the campaign open for 4 months. Initially, we had it open for 3 months. We extended it a month. The perks we had started with a $100 minimum, and then I believe our perks were not aggressive enough to the upside. So like our best perk was getting our subscription for life, and that was only a $1,000 investment. If you look at 2019 and 22, we made it a $5,000 investment. We literally 5x'd the value of that specific perk. And so a lot of people just invested $1,000 because they just wanted our app for life for free, complimentary with the investment, and so they only invested $1,000. So if we were to redo that, we probably would have increased those perks, made it more compelling. But in the end, we closed with 137 investors. One of those did fill half the round. So it's very powerful if you can get the VC to come in, be the first investor, lead the round, and that was our pre-seed round. Moving over to 2019, definitely a different picture from a business fundamental standpoint. So you could call this our seed round. We had a lot of momentum. I had this chart showing our paying subscribers, and we were literally going to the moon. It was just compounding growth. Everything looked really good. We were at about $1 million annual run rate. So I believe we were around 100,000 a month, something like that, or just under. And we raised on a SAFE again at a 10 million valuation cap. And I believe our early bird special, which is really important that you set that up, the first 200,000 raised had a 20% discount on that valuation cap. We had the campaign open for only 3 weeks. So we sent out a few emails, we did the pre-launch, and boom, we had like literally $250,000 after 2 emails. It was really ridiculous. We should have kept that campaign open because we had momentum, we had everything going for us, and we closed it, I think, prematurely now that I think about it. At this point, if you have traction and people are investing and they're coming in troves, I mean, we should have just closed the investment and then reopened it like a month or 2 later, or maybe 3 months later. You can raise once every 12 months without having to like refile your Form C and everything. So we definitely should have capitalized on our traction. We sent out not that many emails when we think about how many emails we sent in 2017 and even this last campaign. In the end, we raised just under $500,000, 205 investors. Maybe 20 to 30 investors were repeats from the first round, and they were committing more at double the valuation cap. So because we had the traction, right? Definitely the best investment campaign that we did. Then in 2022, we had a lot of things go well and a lot of things go terribly. Let me explain. So we could call this our bridge round. I was actually hoping to raise about $1 million or more. We ended up only raising $344,000 from 322 investors. Similarly, about 30 of those people came over from the last 2 rounds. We've had some people invest every single campaign that we did. But in terms of traction, we definitely had a bigger audience. On YouTube specifically, the MySwimPro channel, we had around over 250,000 subscribers or something like that when we launched this campaign. Definitely over maybe 200,000 subscribers. Now we're at 350,000 subscribers when we closed the campaign. And we were doing more in revenue, 1.5 million annual recurring revenue. But if you look at this, the COVID pandemic really shot us in the foot because we had like a stall in growth. And so we kind of like went backwards in 2020. We're climbing ourselves out in 2021. And now in 2022, we're sort of back on track. But that 2-year gap really killed us in our momentum and traction. So even though we had this incredible brand growth, a community of like 1 million people online following us, pools are closed, people are not paying attention to the Olympics in Tokyo, stuff like that. So that definitely hurt us. We raised on a safe again at a 15 million valuation, and actually our early bird perks were at $500,000. So we never even reached our early bird special on the investment side of things because we never passed $500,000. And so we had a higher valuation cap above $500,000. It was $20 million cap, and we never touched it because we only raised $344,000. So that definitely hurt us in the structure because we didn't have that much momentum. We launched the campaign in the middle of 2021, and we didn't close it until 8 months later. And we were really hoping, we got initial traction. We raised about $250,000, $300,000 in reservations in the first month. We sent out a few emails, we got traction. But as time lingered on, we were not able to carry momentum. And I'm going to talk about some of those reasons. And if you're thinking about raising, you have to watch this because it's absolutely huge to understanding if you're going to set this up for yourself. So we had this stalling campaign, a lot of reasons why we delayed it and it didn't end up closing with as much money as we want. But I think the perks we set up pretty well. It was a $100 minimum like we did in 2017, and we had $5,000 for life. I skipped over it, but our minimum in 2019 was $500. So we had a 5x increase in our minimum, and I think that did help us increase the overall average value of those investments. I mean, 205, 465,000. Here, we just closed with 300 investors plus, and we only raised 344,000. And we did have a couple of bigger whale investors that came in with bigger amounts to lift the average. So as you can see, much lower average investment point in 2022. So let's talk about the good, bad, and ugly. And I think we're gonna wrap this all together with talking about some of those lessons learned here at the end that are critical. You need to make sure you watch that. So the good, bad, and ugly. The good, 3 bullet points, here we go. Community gets skin in the game, skin in the business. So it's great that you have these evangelists, they're trying to help, they really love your brand. They're wearing a t-shirt like this, they're really hyped about it. So that's obviously great. You fill your bank account. So if you have any kind of success, even if it's less than you want, you're still getting money in the bank account. Sure, you're selling a part of your company and maybe you're not doing it at the terms that you want, but at the end of the day, you're raising money. And if you pull in money to the bank account, that's a success because that's the whole point of doing this. And then it's all digital. So you're not doing in-person meetings. I mean, I did a few of those, but for the most part, you're pretty much doing everything on the computer. You send out some emails. If you have a list, leverage the heck out of it. And email is where all of this the magic is gonna happen. If you notice, I talked about advertising, 0. We didn't do advertising, we did emails. I talk about advertising and what that means in the what we could have done better or poorly, or actually it's in the ugly, we're getting to that. Bad. So coming up with perks is actually really difficult, especially if you have a digital product. So we have an app subscription. What are the perks? And it's difficult to tie that in because the people who are coming to our app and paying for our service, they don't really want a physical thing. So, even if we included my book as one of the perks in this last campaign, you invest $1,000, I give you a hardcover book that I published, and you can check this out on Amazon, but getting the signed copy by the author, me, I'm kind of an influencer in the space of swimming, that's great and all, but what else can we give people that they might actually be interested in? We had a $5,000 perk for the lifetime. But after that, we had t-shirts, we have vests, difficult to come up with perks. You also have to educate people a lot. Just because we've done this before and it's becoming more common, it's still something that needs a lot of education. That's actually why I wrote a book on how to invest in startups, because I went through this 3 times and I've interviewed hundreds of CEOs and understand the process, but there's still a lot of education that needs to be done. And then the third bad is that you are managing investors. So if you don't raise any money, you don't have to deal with any of this. You still need to send a monthly update. I've been very religious with those monthly updates. And not only that, you have to have a certain level of transparency that not everyone is comfortable with. I have it listed as a bad. It's not really that bad, but you're accountable to it, which is good. But some people are not as comfortable sharing an annual report where they talk about the revenue and expenses every single year forever, basically, as long as you have this investor base. So something to keep in mind. The ugly, here we go. This is good stuff. So reservations versus commitments. I talked about this a lot here. You want people to make reservations, and that's great. So they'll come in, they'll commit, I'm gonna invest $100. I'm gonna pledge to invest in SpaceX $1,000. How many of those people will actually convert into investing in your business? Now, the way that this has kind of changed in the last few years, now it's easier than ever to test the waters, to set up a community round, to pledge for investment, and it's much easier to drop off and not actually follow through with that. So in 2017, most of our investment reservations actually came through. This 130,000, maybe a few $1,000s didn't come through. In 2019, maybe we were around 400 something, but it was a little bit higher than 465, and we had some drop off, but maybe like 5%. We closed this campaign with, I believe, over $400,000. And then it was 380, and then the amount that we actually closed was 344,000. So there was like 20 to 30%, maybe about 20% attrition from the reservations that people had put in. They put in the account, and they never actually followed through when we closed the campaign and invested. And I think it's because it's so easy now to basically set it up and test the water. So you have to understand that whatever amount you see, you got to take off 10 to 20% minimum. And not minimum, but you should take off mentally 10 to 20% is what you're actually going to close. Now, another thing here is that the market is determining your fate. So you may have a rock star business, you do everything right. I think we did a lot of stuff right. But depending on the timing and the market and the way things are being perceived and COVID and whatever, the war in Ukraine, so all of this stuff, you don't control any of it. And when you're raising privately, you actually have a little bit more control because you're controlling the story one-on-one. It's more work in certain ways, but you control that story. So the fate is determined by the market, which is definitely an ugly thing, which I'll talk about some of those here in a couple seconds. And then finally, we spent $30,000 on an agency and all of our money basically went to nothing. That's right, we used an agency to help us with paid advertising. We spent 30 grand, and after all of this time, we tried to tweak it. The advertising wasn't good, and we basically pulled in, I think, $7,000 in investment from $30,000 upfront, not upfront, but along the way. We spent 30 grand and we only got 7,000. Think about the negative ROI on that. And it was a huge time suck. We would have been better off literally doing anything. So definitely negative experience with that agency. There are some good ones out there. By the way, it's Aurora Project. They were a lot of hype. I've hyped them up before, and yeah, they kind of let us down and they didn't even try and do much to fix that. So yeah, you would have thought they would have seen some of my YouTube content and would have tried to help us out, but nope, they didn't really give a crap. So that's the ugly. Now let's talk about why I think we could have raised more and why we didn't. And so let's start with number one. So company performance. So if you look at our trajectory, we had incredible growth leading into the pandemic. We were on a rocket ship. Then we had the pandemic and things faltered, and we're still trying to figure out how to come out of the pandemic, right? So I think we're still making progress, but the company performance is not as exciting. So all the people that I've been educating about our company and seeing our progress, it's not that exciting compared to what it was a couple of years ago, and the pandemic is only part of that. So that's definitely one reason that hurt us. Another thing is the saturation of our core investors. So we have almost 600 investors. Some of these are OGs, and they invested at a lower valuation cap. So they're incentivized to continue to invest as we keep growing and increasing the valuation cap. And also, we've exhausted the perks. So they already invested $5,000 and they got our lifetime subscription. There's nothing else we can offer them in terms of perks besides another t-shirt. And if you're investing $5,000, you don't really care about a t-shirt. You can go buy that whenever you want. So yeah, definitely some challenges as you continue doing multiple rounds, saturating your investor base, and there's increased competition online. So if you're watching this video and you made it to the end, or we're about done, thank you so much for your time. But also, there's a reason why you're watching this, because you've probably seen it done somewhere else. You've seen another company besides mine raise money online and you're curious. All of that is competition. So it's good for the overall market, but if you don't have the shiny object, the thing, the incredible parabola growth, depending on the market, you may not be as successful as you would have been a few years ago because there's more competition. Granted, there's much more investment out there. There's way more people investing and interested, but it's still definitely something to consider. And then the swim market sentiment. So our company is in the category of fitness, more specifically swimming. And if you haven't realized, when the pandemic came around, all pools closed. So there's this period of time, and I think people are still bitter about that. Some people still have not returned to the pools. Some pools, depending on when you're watching this video, are still closed because of COVID. Some have shut down permanently. So definitely put a wrinkle or a pimple in the swimming space because of COVID, and we're still not fully out of it. And I think it'll take actually a few years. Some people are rubbed the wrong way from other things in the category of swimming as well. And finally, market timing. So two major events happened when we were closing the campaign. One of them is the crisis in Ukraine and Russia and oil prices and gas prices and the price of everything going up. At the same time, the stock market was tumbling and the NASDAQ and tech stocks had seen their biggest decline in over 10 years. So you think about alternative assets that are getting destroyed, people are not as interested in risk when they see a war on television and they see their 401k or their investments going down the drain. So that's when we closed the campaign, literally some of the biggest single day declines since the pandemic in 2020 of March. So yeah, a lot of different things that factored in. And like I said, you can only control so much of this. Some of it you can't control, and the market is going to determine your fate. So definitely want to consider all of these things before making the either investment or investment in time to raise money online. But like I said, if you want to do a test the waters or petition a startup, it takes 15 minutes. Use the link down below. Hope you guys enjoyed the video, and I'll see you guys next time. Bye.